Signs that a recession is coming. Welcome to today's mortgage market update for April 4th, 2022. We forecasted a recession months ago and we showed you how it was going to happen in our 2022 forecast in January. And now you are hearing it all over the news about an inverted yield curve. But what does that all really mean? Let's break it down for you. First, let's look at the yield spread. We're going to show you what a normal yield spread looks like and where we are today. Yield spreads has to do with the treasuries and how the US government sells them and the difference in the maturity. Think about it this way. If you're taking additional risk, tying up your money for a longer period of time, you should be compensated for that, for tying your money up for that longer period of time. And that's what normally happens. But during these unusual periods, when the treasury curve gets inverted, you get a better compensation for tying your money up for a shorter period of time. It's really unusual, and this is a really strong sign that there's something going on underneath there, the surface, that something else is happening. So let's show you a chart so we can explain this to you. So, okay. So, whoops, wrong thing. So you should be able to see my screen. And on here, you can see that under a normal upward curve here, this light gray line, this is what a normal treasury curve looks like. And the longer you go in maturity, the more you get paid in your yield. So the more you're earning on your investments. And this light gray line is the 2020 yield curve. This darker gray line you see here is your 2021 yield curve. And this blue line here is what you see right now. Now, this happened in 2019 as well, right before the recession of 2020. And you can see here that in the 20 year the 20-year treasury right now is actually paying higher than the 30-year treasury. So again, this is just unusual. You can see how it's this big swing. It just looks very, very different than the current yield curve. And this is something that we need to pay close attention to. Okay. So oftentimes this singles a recession ahead, and the normal benchmark is when a 2-year is paying more than a 10-year, which is actually now inverted by 3 basis points. So what that means is the 2-year is paying more than a 10-year treasury. And we're going to continue to watch this, and this is something you're going to be hearing a lot about in the news. So what does this all mean? Inversions are actually not necessarily a bad thing for the real estate market. In fact, it's actually typically a good thing for us because during recessions, mortgage rates actually go down and housing values actually go up. So let me show you another chart that's going to show you how that works. Okay, so now you can see this chart shows you from the 1960s through and on all the recessions. So these gray lines, these dark blue lines, I should say, are all the recessions, and there was 9 of them. And then this white line is showing you the S&P, the Case-Shiller home values, and you can see that starting in the 1960s, they was pretty much flat, but from there it went up, just right through this double recession, up, up again, pretty steep curve here. And then right here, you see in about 2006, 7, 8, we have this housing bubble that happened. And we have to remember this was a very different market. So in this time, you had the 580 credit scores, you had the no income, no asset loans going on. We had way too much supply and not enough demand. So that's what actually caused the downturn in the housing values, not necessarily the recession. And that is our belief. Because if you actually draw a line here, you can actually just skip over that housing value there. So we do believe the downturn here was because of the housing bubble and not the recession. But you can see during the last recession in 2020, we blew right through that. And again, it is believed that we are going to blow right through the next recession that we are headed into as well. Now, you don't necessarily know when you are in a recession until after it happens, and that is because typically a recession is gauged by having two negative quarters of GDP. So it's something that you have to look backward on in order to see it. So keep in mind, a recession is a good thing typically for the housing market, but if you go back and watch our 2022 forecast, you will see that recessions are not a good thing for the housing market, and of course, it slows down our economy. So just keep in mind that these are things that are happening, and we're going to keep an eye on this for you, but we wanted to show you how recessions are not a bad thing for the housing market and for mortgage rates. And we do want to also show you the, let me show you how the mortgage-backed securities right here. These are where mortgage-backed securities are trading since January. And these are, you'll see this big decline here, which decline on here means that mortgage rates have gotten worse. So if you Google average mortgage rates, you will see, and let's just do that real quick, because you will see that mortgage rates have gotten a lot worse. See, look right here. If you just Pennsylvania 30-year fixed 5.4%, and I can tell you we can actually do better than that. 15-year is at 4.3. So you can see average rates. All I did was just Google that. You just watched me do it. Um, how high they actually are, and that is because of this decline in mortgage rates. So we are hoping to get out of that. There is a bump here today. If you draw a line here, oops, I'm on the wrong tool. Sorry. Um, if you draw a line here, we could possibly get out of this today, but we'll see what happens in the market today. So, um, there we go. So that's what's going on in the market. We are likely headed for a recession, as we've been telling you. We just wanted to show you some signs of it, that it is still happening. We can tell you that people are still refinancing. 41% of the market and mortgage applications are still refis. It is people that are paying off debt. We're consolidating debt for people. Our purchase activity is sky high, though. We are doing a lot of purchase loans. If you need help getting your offers accepted, reach out to the Rebecca Foot Mortgage team. We have a lot of creative ways to help you get your offers accepted. We are even offering sellers a $5,000 seller guarantee if we don't close on that buyer's loan. So make sure you reach out to the Rebecca Foot Mortgage team. Let us tell you more about it. And we hope everybody has a great week.